Understanding itemized deductions. Itemized deductions are a crucial component of the U.S. tax system, allowing taxpayers to reduce their taxable income and ultimately save on taxes owed. This article delves deeper into the concept of itemized deductions, offering insight into the various types of expenses that qualify, how they are reported, and how they compare to the standard deduction. What are itemized deductions? An itemized deduction is an expense that can be subtracted from your adjusted gross income, AGI, to lower your taxable income. By providing this deduction, the tax code allows taxpayers to exclude certain personal expenses from their gross income, thus reducing the overall tax burden. Itemized deductions can include various expenses such as mortgage interest, interest on loans secured by your home, charitable contributions, donations made to qualified charitable organizations, unreimbursed medical expenses, medical care expenses that exceed a specified percentage of AGI. State and local taxes, this includes state income taxes or sales taxes, as well as property taxes. Casualty and theft losses, losses due to disasters or theft, previously subject to limitations. The benefit of itemized deductions. The primary benefit of claiming itemized deductions is the reduction of taxable income. This passes through to your final tax bill, lowering the total that you owe to the Internal Revenue Service, IRS. The amount of tax savings varies depending on your tax bracket. For instance, an unmarried single filer with a gross income of $80,000 who claims itemized deductions totaling $15,000 would derive actionable savings by lowering their taxable income to $65,000. Depending on their circumstances, this could land them in a 22% marginal tax rate bracket, yielding significant tax liability reductions. Documentation requirements. Taxpayers choosing to itemize deductions must meticulously document and report these expenses, listing them on Schedule A of Form 1040. It's important to keep all receipts and records of the reported expenses, as the IRS may request this documentation during an audit. Acceptable proof may include bank statements, insurance bills, medical bills, tax receipts from charitable organizations. Failure to maintain accurate records may jeopardize your ability to claim these deductions. Itemized deductions versus standard deduction. Taxpayers have two choices when filing their taxes: they can either itemize deductions or opt for the standard deduction. The standard deduction is a fixed dollar amount that reduces your taxable income, and for many, it can lead to a more straightforward filing process. Choosing between itemized and standard deductions. The decision to itemize or take the standard deduction should depend on which option presents the lowest tax liability. For the 2023 tax year, single filers or married individuals filing separately have a standard deduction of $13,850. For the 2024 tax year, this amount increases to $14,600. If the total of your itemized deductions is less than these amounts, it may be beneficial to opt for the standard deduction. Certain taxpayer groups have specific rules regarding deductions. For instance, non-resident aliens must itemize their deductions. Additionally, married individuals filing separately must both choose the same type of deduction, either itemized or standard. Conclusion. Itemized deductions play an important role in the U.S. tax system, allowing taxpayers to lower their taxable income through eligible expenses. Understanding what qualifies as an itemized deduction, the documentation required, and how to choose between itemizing and taking the standard deduction is essential for making informed decisions that can lead to significant tax savings. Always consult with a tax professional or utilize IRS resources to ensure you maximize your potential benefits within the legal frameworks outlined for your particular tax situation.